We mentioned tax shelters around preparer penalties, but what are tax shelters? Generally speaking, these are tax positions which ultimately lower tax liabilities. Tax shelters may be classified as reportable transactions which need to be disclosed on Form 8886. Note, this form not only needs to be filed with the return itself, but also separately filed with the Office of Tax Shelter Analysis. Let's take a look at the 5 major categories of reportable transactions. Listed transactions are those specifically listed by the IRS. These may be found on the IRS website, updated periodically under listed transactions. Confidential transactions, on the other hand, are tax avoidance strategies sold to taxpayers by practitioners under terms of confidentiality. Note there is a minimum fee requirement to be charged in order to qualify. The contractual protection type of reportable transaction occurs when the transaction is offered with the right to full or partial refund of fees if the IRS does not allow the tax benefit of the transaction. Transactions where the taxpayer claims extraordinary losses may meet the definition of loss transactions, meeting the requirements of a reportable transaction. There are some exceptions, noted here, to reporting requirements when losses stem from these sources. Finally, transactions of interest, or TOI, are transactions the IRS and the Treasury Department believe have the potential tax avoidance or evasion, but lack sufficient information to determine whether the transaction should be identified specifically as a tax avoidance transaction. Think of this as the emerging issues category. Again, similar to the listed transactions, the IRS publishes an ongoing list on the IRS website. Not disclosing and reporting tax shelters comes with some hefty penalties. Reportable transactions are not all bad, and reporting them on Form 8886 does not mean the IRS will say no to the strategy. Instead, tax shelters serve as a reminder to tax practitioners to be cognizant of the tax law.